How do you calculate a price in a sale to an employee ownership trust, an EOT? As accountants will tell you, there is no one way to value a business. Indeed, business valuation is often described as an art rather than a science. What is important for the transaction to go ahead is that the number arrived at is acceptable for the seller at a price that is comfortable for the buyer. Business valuations are generally influenced by three metrics: asset value, future earnings, and dividend yield. What assets does a business hold, and how do we quantify the value? It might be easy to put a price on bricks and mortar property, less so on intangible assets such as intellectual property. Future maintainable earnings, i.e. the cash the company can generate in future, is typically the key component in the formulation of the valuation. A review of historic, current and prospective trading will give a picture of the maintainable EBITDA, that's an accountancy term, meaning earnings before interest, tax, depreciation and amortisation. The EBITDA figure will exclude exceptional items from the calculation, and as most business owners draw a minimal salary and are remunerated largely by dividends, include the cost of a fair market salary for the sellers if they are to remain with the business. Dividend yield is not often used for valuing a business for an EOT sale, but can be a useful indicator for calculating the repayment of deferred consideration. Once we've arrived at EBITDA, we apply a multiplier to arrive at a price. This multiplier will differ depending on the sector, the company size, and forecast and the market. Typically for SME businesses, that multiplier will be between 4 and 6. To that figure, we add any surplus cash in the business, i.e. allowing sufficient working capital to remain to allow the business to function comfortably, or we subtract any debt obligations. Let's take an example. We calculate the EBITDA for Acme Enterprises Limited to be £100,000. We agree that a reasonable multiplier for Acme is 5. This gives us 500,000. There is 200,000 additional cash at the bank. An approximate valuation for Acme would be around £700,000. Of course, it is much more complicated than that. Many factors will influence the true value of the business, such as the reputation of the company, the current economic climate, any changes at leadership level, stable contracts and so on. And of course, a competitor may pay a premium to acquire a business to gain control of the customer base, the IP, or just to take the business out of the market. So we have our price. How do we fund the transaction? It's usual for the EOT transaction to be funded by the company. The sellers can extract the surplus cash in the business at deal completion. The remainder of the purchase price can comprise external lending and/or deferred consideration by vendor. The company can borrow from a bank or specialist lender to fund some of the deal. This debt sits on the company balance sheet and is repaid by the company. There is an increasing appetite from lenders to fund EOT transactions. Bear in mind, the trust is the buyer of the shares, with funds provided by the company. We calculate a repayment schedule, carefully set at a level that will pay the seller within an acceptable timescale and will not put any undue pressure on the business. These repayments can be timed to fit within the company's cash flow requirements, with payments made quarterly or annually. It is advisable for the seller to take advice on personal financial and tax planning to ensure they are maximising the benefit from the payments. And remember, in an EOT transaction, the value is paid completely free of tax to the seller. What happens if the company is sold before the debt is repaid? It is usual to include an anti-embarrassment provision within these transactions. This allows the seller to benefit from any uplift in value should the company be sold subsequent to the EOT. The seller is bearing some risk here, and we would normally incorporate significant protections into the deal to mitigate these risks. For instance, the seller would have the right to remain as a director and trustee while there is consideration outstanding, and may also have vetoes over certain decisions the company may make. Sellers tend to be comfortable with this. They have confidence the business will continue to be profitable, and this is borne out by research that demonstrates companies flourish when employees have a stake in the business.